Hello, everybody. It's Mark Johnson, and today I wanted to spend a few minutes with you talking about first time home loan programs. When I reviewed all of the loans that I've done over the last 12 months, as I'm kind of in my goal setting time right now, I found that most of my loans are for first time home buyers. And it kind of surprised me a little bit. So it was like 40 something percent, like 41% of my purchase loans were for first time home buyers. And I kind of divide that up into move up buyers and then buyers that are in the jumbo range there. So I wanted to just talk about a few things that you should know if you're looking to buy your first home. Did you know? I bet you didn't know this. 31%, yes, 31% of home buyers today are first time home buyers. And it's amazing to me to look at that and then realize that because I've just always thought that, that was a smaller percent. Did you know this? That in 2010, it was 50% of the home buyers that were out there were first time home buyers. So, that's down a little bit, but it's still a major force that I think we need to pay attention to. And so, if you're a first time home buyer or if you're a real estate agent, you need to listen to what I have to say here so that you can get prepared to buy a home today. Because today's market is so much different than it was 10 years ago or even 20 years ago. So, let's get started. First of all, the most important and there's two things that are kind of a chokehold for most buyers. One is credit, and the other one is down payment. Most of my first time home buyers really have a pretty good income stream, especially if they're married or buying it jointly. But even a lot of first time home buyers have really great incomes today. I especially find that women today make up a lot of the first time home buyer segment of that 31%, or in my case, of the 41% are generally a higher percentage of women. I need to go out and calculate that out. But I have a client right now that makes great money and she can buy a house by herself. She doesn't need a second income. So if you're uh, a woman and you're thinking, oh, I need to wait till I get married, don't wait. Buy now if you've got the income. And that's one of the reasons why the most important thing that first time home buyers can do is get pre approved for a mortgage first. That's the biggest mistake. So many times I have people calling me up and said, I found the perfect house. I need to hurry and get pre-approved. And the problem is they're not quite ready. So apply early. If you're thinking of waiting and buying in, say, March or April, you should be applying now. Whether you buy now or you wait till then, right now is the best time to create a mortgage strategy. And that's why it's different to talk to a mortgage advisor versus a loan officer. A mortgage advisor is somebody that's going to take you step by step and show you exactly what you need to do, explain the different kind of programs that are available, help you get your credit in order, make sure that you have enough finances in order, make sure that your job stability is good enough. They're going to advise you on the things that you can do to get yourself ready today that will help you qualify for the best mortgage that you can get. So let's talk about credit for just a few minutes. It was interesting to me as I went on my different credit cards. I have a Mountain America, I have a Chase, and I have a Capital One. I use these three FICO scores to kind of see what my FICO scores were from the credit card companies. And so let me just get that here real quick. I have a 756 on my Chase account. I have a 788 on my Mountain America, and I have a 784 on my Capital One account. Now, I will tell you this, that my FICO scores, now I didn't pull it for a mortgage, but it's going to be 20 to 30 points lower than what my credit card FICO score is. And the reason for that is that a mortgage FICO score is much more stringent in the way that they calculate how you use your credit, what your balances are, how long you've had credit, how many credit accounts you have, and the types of credit cards and credit. So in other words, have you had a home mortgage? Have you had a car loan or a furniture loan? Those are called installment loans. And then of course, how do you handle your revolving credit? So, I went through a period of time when my credit dipped quite a bit, and all I did was like get my balances less than 30%. And in And so sometimes when I say balance is less than 30%, if you have a credit card that's got like $900 on a $1,000 limit, and you have two other credit cards that you can move the balances over and equalize those balances. So you have $300 here, $300 here, $300 there. You still have $900 in overall credit, but spreading it across three different credit cards is much better than having one credit card with a lot of credit and two credit cards with zero balances. So just a little hint there in helping you with your credit. And so that's one of the most important things you can do is meet with a mortgage advisor that will show you how to manage your credit in such a way that you can maximize your FICO scores. And your FICO scores can go up significantly by just doing a few quick things. But making sure that you do the right things is more important than just, going and paying down your credit card. So that's one of the things that you need to do right from the beginning is make sure that your credit is in the very best credit standing that you can get and get the highest FICO scores that you can get in order to purchase a home. The second choke point, as I said, was down payment. Now, down payment is kind of tricky right now. Most home buyers, they don't have a lot of money for a down payment. It's really good if you have somewhere between $5,000 to $10,000 and maybe even $15,000. You'll get the lowest monthly payments if you've got a large down payment. And when I'm talking about large, I am not talking about 20% down. I'm talking about 3 to 3.5% down. You can get into a first-time home buyer program with as little as 3% down on a conventional loan. And that's going to give you the most favorable terms. It'll give you the most favorable mortgage payment. Yes, you will have PMI on a 3% down conventional loan, but if your home value, once it gets to 78% loan to value, or in 2 years, so in other words, making 24 payments, if your loan to value is at 78% or less, you can drop that PMI in as little as 2 years. And so conventional 3% down, first-time home buyer is the best kind of program for you. Now, if we're looking at a $375,000 loan, your down payment on something like that is going to be somewhere, with closing costs, is going to be somewhere around $17,364. Now, the second way is going FHA. Now, FHA requires a little bit higher down payment, but they're a little bit more forgiving if you have, your credit score is below, say, 700. So if your credit score is above 700, you're going to probably go with conventional if you've got 3%. If your credit score is down around 660 to 640 or even 620, you're probably going to go with an FHA program. Did you know this, that if you have a FICO score above 580, you can still get an FHA loan? Anyway, we'll go into that when we review your credit. So down payment is important, but there are a few programs that don't require down payment. Let me just tell you a couple of them. If you go with Utah Housing, that's an FHA loan that is funded by the FHA Housing Department here, the Utah Housing Administration, that's part of Utah. It's part of the Utah government. And so they make loans to people with zero down. Now, your payment's going to be significantly higher because they're going to lend you up to 6% on a second mortgage to fund your down payment and your closing costs. So what I found is that monthly payment is usually somewhere around $450 more per month for the same sales price because you're borrowing money for your down payment. And so, again, if you can come up with the down payment, you're going to be better off. Now, people say, well, where can I come up with a down payment? Well, there are programs out there that will give you money. So in other words, there are state, county, and city grant programs that will gift you, anywhere from $5,000, $10,000, maybe even $13,000. And you just have to stay in that house for 5 years. After 5 years, that loan is forgiven. The problem with the grant programs right now is that it takes so long that most sellers won't wait for that grant program to come through. However, what I found is if you can borrow money, now here's a second way that you can get your down payment, and that is to get a gift from a family member. So a gift from a family member can be for a few $1,000s all the way up to 100% of your down payment and closing costs. So if your down payment and closing costs are, say, $17,000, and you've got a relative that will gift that, like a mom or a dad, or a grandparent, you can use that money for your down payment and your closing costs. So the other program that is excellent is that if you buy in a rural area, such as out in Tooele or out in Eagle Mountain, are two places that still has the USDA program that is 100% financing. You do have mortgage insurance, and you have a one-time fee that is added onto your mortgage. And so you can buy in those areas and other rural areas throughout the state of Utah, as well as in other states. And so that is a really great program if you can, if you're not looking to buy in a major metropolitan area. I believe the maximum, I'm not going to go into how many people live in and have to live in that city or county, but anyway, for more information on USDA loans, just, give me a call. Now, the best program out there is if you're a veteran, and happy Veterans Day to all the veterans that are out there. My heart goes out to you because you have sacrificed so much for this country. Now, the Veterans Administration, the VA loans were the first loans that I really got to be an expert with. My dad used to work for the Veterans Administration in the VA home loan department. So obviously I got help from him when I first started in the mortgage business way back when. And what we were doing for you today and every day is we are waiving all of our lender fees to do your loans. We appreciate what you've done for our country, and so you can get in with 100% financing. There is a VA funding fee that is added to the mortgage, but there is no monthly mortgage insurance. So what that does is give you the lowest rate, the lowest payments, with 100% financing that's out there. So those are just a few things that I wanted to share with you as far as first-time home buyers. I want to give you 8 things that you should never do before when you're buying a home before you close on that home. Number 1, don't make any new car. Don't get any new car or buy any major home appliance or anything on credit. Number 2, don't maximize your credit cards. It'll bring down your FICO scores. Don't quit or change jobs in the middle of the loan application. Now, if you're going to do it, or if that's part of what you're doing, it doesn't mean that you can't do it, but you need to make sure you do it in such a way that it doesn't goof up your mortgage financing. Generally, if you change jobs in the middle of getting a home loan, you will not be able to get that home loan. So make sure you check in with your mortgage advisor. Then the other thing is, don't assume you need 20% down. I can't believe how many people, I had one client that said, hey, we're just saving up for 20% down. I asked them, how much money do you have? I said, I've got about 10% down. And I showed them how they could buy a house right now versus waiting another year or two to save up that extra 10%. And they were able to buy a house a lot sooner than what they thought they could do. Also, don't make any financial changes before closing. In other words, don't purchase a car or truck. Don't increase your credit card balances. I've already talked about that. Don't open any new cards, and especially don't apply for any kind of loan whatsoever, even though you're not going to get that loan until like after you close. Just that credit inquiry will trigger your lender on that you've applied for a new mortgage, and then you've got to write an explanation, and then that might hold up your loan closing. Also, don't move money around, so if you've got money in 3 different places, if you do move those around to one account, make sure that you do it in such a way that we can verify those transfers, okay? And then also, don't ever close credit cards. When you close a credit card, believe it or not, your FICO score will go down for just a little bit. So don't close any credit cards. I want to just make sure I said that. So in summary, the first-time home loans that are out there is FHA, there's the VA program, there's the USDA, there's the first-time conventional 3% down program. There's also other loan programs out there like the Neighbor Next Door for first responders and educators and things like that. So there's just a whole lot of different things that can help you get into the right mortgage for you and your family. So I'll post below a link that will show the FHA, the conventional down payment scenarios, VA and USDA. And if you have any questions about it, just click on the link. It'll bring up a scenario that will show you the difference in the monthly payments, the monthly down payment. It'll show you where you'll be in 5 and in 15 years, depending on which mortgage you choose. So click on that link below. I'll have that in the next 10 minutes for you. And if you have any questions, don't hesitate to call me. All right, thanks a lot. Have a great day.